Good morning, everyone. Joe Mass here. It's July 13th, 2022, about 10:20 in the morning, and we just wanted to give you a quick update. This morning we got, hotter than expected inflation numbers year over year. So what does that mean? Well, it might mean the Fed might be, a little more aggressive, right? There's talk today, chatter about a 1% historic increase in the Fed funds rate when they raise rates here coming up shortly. Definitely going to probably stay at 75 bips. So again, they're worried about fighting inflation. That's the Fed's, even though they have dual mandates, what they're worried about right now is fighting that inflation number. And so we would expect them to stay aggressive. So on this chart, you're seeing, the CPI here year over year came in at 9.1, a little higher than expected. Again, I think the nice part here is that we are starting to, peak probably. This is probably going to be the top of the tape here at 9.1. There are signs of certain commodities pulling back. Commodity prices are what raise inflation. So, we'll have to just wait and see there. I wouldn't expect us to see much higher than 9.1 year over year, but you never know. I think there are some signs that we're getting to the peak of inflation. So what we're looking at here is the headline year-over-year numbers at 9.1. You can see the dashed line is the core. And then you have the blue line, which is services, X food and energy. The orange line are goods, X food and energy. Food is the orange line, and then you have energy, which is taking up a large portion of that inflation number in the green. So energy has pulled back a little bit. There's a lot of debate. Goldman Sachs thinks that oil can be at 140 by August. We have seen the energy markets pull back here recently. Long term, we're still bullish on the energy sector, and we think that's a good place to be to help fight inflation. Having equity exposure to that sector is still good. It's kind of a love-hate relationship, right? We want the returns from the sector, but we'd love for the gas prices to come back down. So it's kind of a love-hate relationship there with energy. But that's where the numbers are sitting. More importantly, what do I do, as an investor? And we've been talking about this for many weeks now, probably even over a year. But it's so important. I want to just mention it another time. There's two sides of the coin. On one side, you have, risk on, and the other side, you have risk off. So on one side, there's the geopolitical risk you're trying to face, and on the other side, you're trying to fight the risk of inflation. So to fight risk, you need to be in cash and bonds and risk-off assets. Of course, the risk there is that with inflation at 9.1%, you have negative real returns. Your other option on the other side of the coin is to fight inflation, and that's to be in equities, in value and energy like we just talked about. Maybe some tips, right? We've rotated recently into some Treasury inflation-proof securities. Asset allocation, our sailboats are doing very well to fight both the risk and inflation right now, and commodities as well. So the NASDAQ is recovering pretty well. The large caps are coming back here today as I'm watching the tape live. So again, we still believe in being in the world's largest and best companies to fight inflation, even though you may have some temporary downturns. That is probably going to be a good place to be in the equity space. So continue to maintain and hedge your portfolio. What are we going to do? Again, not much different. If people are asking me, what are we doing? What are we doing? Well, we're maintaining our course and speed because we're right in the middle of a storm, and there's not a lot more we're going to do other than manage our portfolios prudently based on each portfolio's mandate, and we're happy with the way they're performing. So, we're still suggesting diversified portfolios via broad asset allocation. And then we're just watching the data and try to recalibrate as best as possible. Again, we're not market timers, but we're trying to stay ahead of the curve, right? Keep the portfolios positioned appropriately for these times of uncertainty. And so we're pretty happy with our processes and portfolios so far this year. So with that, I just wanted to say thank you and give you a quick update there. Hotter than expected inflation, probably going to get an aggressive Fed, and we'll wait and see. Talk to you next week. Everyone have a great time. Thank you. Bye-bye.